Have you ever wondered why businesses spread the cost of a big purchase over many years? That is the concept of depreciation. Depreciation is the process of allocating the cost of a tangible asset over its useful life. Think of it as accounting for the wear and tear of equipment used to run a business. To calculate this, accountants look at how long the item will be used and what it might be worth when they are done. Unlike a simple office supply purchase that you expense immediately, big assets like machinery are depreciated to keep financial records accurate. This chart shows a common method where the asset's book value drops steadily until it reaches its salvage value. Keep in mind that depreciation is a non-cash expense, meaning no actual money leaves the business when you record it. Understanding depreciation helps you see the real financial health of a company. Subscribe for more basics on accounting and finance.